Today we're going to be talking about how to profit from the market without timing the market, and how to avoid the mistakes that will blow out your account if you're not careful. So I want to step through a potential scenario for you, and this is actually a very, very recent scenario. Has this ever happened to you? Maybe you have some kind of chart pattern or some kind of catalyst, some reason to get long in stock. And you say, okay, the stock's about to break out, or maybe it's at support, or some reason that motivates you, that compels you to put risk into the capital markets and to expect price movement. Okay, that's the way you're going to make money in financial speculation in this particular case. And it doesn't necessarily matter whether you're doing stocks, bonds, currencies, commodities. You're a directional trader. So you get long, you buy the breakout, and everything's working out great. If you haven't noticed, this is a chart of the S&P recently. And everything's going great, but then, the stock or market stalls out, and then it reverts back to the mean, and maybe the breakdown or the breakout fails. And you say, okay, this didn't work out, so I'm going to get stopped out. And right after the stop out, the stock reverses on you again. And then it rips higher again. And maybe not, it sees a little follow through, maybe you chase, maybe you don't, and then the stock or market reverts again. Reversion can be the death of a trader, specifically a directional trader. When you're timing markets, you need price movement. Okay, basically, you are bullish on volatility. It doesn't matter whether you're bullish or bearish on a stock. If you're short a stock, you really want it to go down. If you're long a market, maybe the euro, maybe the bonds, or stocks or whatever, you want that market or stock to really go higher. Okay? But if you're trading directionally and you see a lot of reversion, if you see a lot of what we call statistical noise, you get chopped up, right? And your position size dwindles, or your account dwindles, and you run out of enough liquidity to really make good returns on an absolute basis, and that's where you get into a lot of trouble. That's the problem we have, okay? And there is nothing wrong with directional trading, but there is an option available to you where you can make money without having to time the market. And in fact, it actually pairs very well with directional trading. So what we're going to talk about today is what you really want here. If you want above average returns relative to what the market gives you, if you want those returns with lower risk and less capital required and less time needed to monitor positions and not getting chopped around in a position, then this presentation is going to be right for you. Okay, that's what we're going to learn about today. Sam is saying in the Q&A box, hi Stephen, I got chopped in Apple this week. Apple is a great example. Apple is one of those very emotionally biased stocks. Either you're a fanboy or you hate it. And Apple tends to have 2 months of brilliance, and it tends to trend for about 2 months at a time, and then it farts around, and it goes into a range. And we see statistical noise and reversion for a couple months after that. And if you try and trade the trend when the stock or market is in a range, that's when you get chopped up. Okay, and we're going to talk about a technique you can use to reduce the losses that you have as a directional trader, or to just get an extra kind of income stream. So who am I? I'm the head trader at investingwithoptions.com. I like to call myself a recovering engineer. My background is in random processes and stochastics. It just so happens that stocks tend to move in what we call a stochastic process. It's almost random. I don't believe that the market's random. I don't believe that the market's efficient, but for about 80% of the time it is. My edge lies in understanding where that 20% is not, and looking for trends and looking for direction, and then using this kind of strategy that we're going to talk about today to make money when I expect the market to have statistical noise and reversion. So before we get started into this one cool strategy that I want to share with you, we're going to talk about first The big problem in capital markets right now and what you can do to beat these markets, and most importantly, and this is the thing that a lot of people completely forget about, how to avoid blowing out your account. Because the strategy I'd like to share with you is a really good strategy, and it can get you great returns as long as you know how to manage your risk. Nobody wants to talk about it. It's not fun, it's not sexy, but we're going to talk about it today. So if you haven't noticed recently, you may be asking yourself, why the heck are we getting chopped around so much? Why is the market in so much reversion right now? Well, from a macro standpoint, you could make the case and say, there's not as much liquidity in this market anymore. We're seeing quantitative easing being pulled back, at least when it comes to the overall, the Federal Reserve. There's different QE with respect to the central bank, European Central Bank, and Bank of Japan. That's actually conducive to being bullish on stocks. Energy kind of sucks right now, and it's just been a very reverty kind of market. And yes, we still are in a bull market, but we've seen a lot more ranges. So here's the current situation we have. We have these things called central banks. We have the Federal Reserve in the U.S., we have the European Central Bank in Europe, and the Greek exit, or the Grexit, whatever they're calling it right now. I wouldn't be surprised if there's European shenanigans starting up here in the summer, because that's when the Europeans like to protest. It's in the summer, it's nice weather and everything like that. You also have the Bank of Japan, you have the Swiss National Bank, and a couple others. These set key interest rates based off of what interest rates are available to lend, and there's some other what I would call macro voodoo or witchcraft, or whatever you want to call it. We're not going to get into the mechanics here, but one of the motivations that these central banks have with respect to setting interest rates is to help dictate, risk appetite, and to help provide better lending and some other things to stimulate the economy. It's monetary policy. It's a lot of voodoo. But one of the things that this does is, when these interest rates are set, it helps to define, first off, the risk-free interest rate. It helps to define what kind of assets you should allocate your capital into against that risk-free interest rate. Okay, so for example, one of the things that a lot of institutional investors look at is that they look at the 10-year yield on treasuries, which that is a rate that isn't exactly set by the Federal Reserve, but it's goosed along by the Fed. Okay, and we look at that 10-year yield, and we compare it to the dividend yield in the S&P, and we can take valuations based off of that. There's some other things going on, but basically, very low interest rates tend to be conducive for stocks, and there's some other things going on that lead to certain commodities running and everything like that. Okay, a lot of volatility, a lot of uncertainty. People say we live in extraordinary times, but if you're a student of market history, this is certainly a new situation, but it's not really new with respect to the uncertainty part of things. Okay. But here's the problem that we have right now, and I don't know if this will matter, but it might matter eventually. This is a chart of the S&P 500, and it's currently up 40% since 2000. And the blue line is CapEx, okay, so the United States core capital expenditures. This is basically how much money companies are spending on stuff, okay, and it's only up 1%. So what's the difference here? Basically what's going on is one of the unintended consequences, or maybe it's intended, we'll see. One of the consequences of very low interest rates like this is that large companies are taking advantage of these low interest rates and basically converting equity into debt. They're buying back their stock, and they're issuing debt at incredibly low interest rates, and the institutions have to buy this because they don't have any other choice because the interest rates are so low. This may matter eventually, okay, but the thing is, from a buy and hold perspective, from a longer term perspective, we're running hot, okay? We're in a secular bull market. I don't know when or where this thing ends, but it's incredibly difficult as a trader to try and hold on to the trend as long as possible. And if you're looking to get better returns, one of the things that you have to do is you're going to have to tighten up your time frames. Okay, you go, instead of trading off of a weekly chart, you trade off of a daily chart or a 30-minute chart. But when you tighten up your time frame, there's only so much price movement available. And when the actual volatility in the market stays low, then you really have to size up. Maybe you start going into the futures market. Maybe you start buying options because you want more leverage. But if you want more leverage, that means you have to manage your risk better, and you have stops. Well, the high-frequency traders and the algorithmic traders, and even I look for stop runs. I look for those levels where people say, oh, crap, I've got to buy protection, or I've got to get out of the trade because I'm wrong, and then the market reverses against you. Here's the little secret. Only about 2 times out of the year is the market in a healthy uptrend. Okay, it only happens about 2 times a year. Now, the duration of that and the magnitude of that is going to be different each time, but generally what happens is that 2 times a year we actually see non-reversion. The rest of the time tends to be much more statistical noise, much more reversion. Okay, so if you're getting chopped around and you're getting stopped out and you're seeing positions reverse after you get stopped out, and it's very, very frustrating, we're going to provide a solution to your problem, and that's going to be iron condors. Now, if you've been around the block with options trading, you've probably heard about iron condors. Now, if you're brand new to options trading and never heard of an iron condor before, we're going to discuss it first. And for those that know what an iron condor is, you're probably going to roll your eyes for about the next 5 slides. I want you to stick with me because the most important part is going to be coming up soon. The main advantage for iron condors is that it is a short volatility trade. Okay, this means it profits from reversion. It profits from range-bound action in the markets. And as we can see, basically, this market has been in some form of range since November. It's been about, 4, 5, 6 months now. Iron condors provide higher rewards relative to the maximum risk that you take, and it does not require as much time compared to babysitting a futures of Forex or options, directional options position. Okay. Dan's saying the screen isn't changing. Hopefully you should be able to see the screen just fine. Okay, I'm going to keep going on. This is an example of an iron condor trade. Okay. This is an iron condor trade. This is a limited risk, limited reward option spread. An option spread simply means that you're buying an option and selling an option against it. Okay, by purchasing the option, it helps to reduce risk and some other things like that. An iron condor is a combination of a bear call spread, also known as a call credit spread, and a bull put spread, also known as a put credit spread. This is actually a live trade. So I looked this up on Friday. This has about 60 days between now and options expiration. This has, I think it's the 2155, 2165 bear call spread, and the 1895, 1885 bull put spread. Now, Tim's saying that this is too dark of a background. This is a high contrast graph. Okay, so I didn't want to put it on a white background because it hurts my eyes when I look at it. Simply put, what you're doing here is you're selling both of these spreads, a bull put spread and a bear call spread. You receive a credit because you're a net seller of options. As long as the underlying market stays between the 2 short strikes, you're going to make money. Now, your reward per spread, okay, the underlying here is the S&P 500. Okay. Fauzi is asking, are we doing a weekly or a leap? This is a 2-month iron condor, so I believe this is a May 5 weekly. Okay, the duration, doesn't necessarily matter. I'm just trying to show you a very specific example. Now, the reward here is 270. So as long as the underlying market stays between about 2155 and 1895, you're going to make $270. And you might say, okay, $270, that doesn't seem like a lot. Remember, you're scaling up. This is just one spread. So if you want a reward of potentially, a couple $1,000s, you just add more to the trade. Now, the total capital required is also the max risk. Okay, and the maximum risk is $730. That means for every $730 you put into this trade, if everything goes well, you're going to make a couple $100. Okay. If we calculate the return on risk, this is simply dividing the maximum reward by the maximum risk, and this is a return on risk of 37%. Now I want you to think about this. Back in 2013, the total return for the S&P 500 was the best of the past decade, and it was about 30%. Now, it's possible that, yeah, you could make 37% on this iron condor, which means that you could potentially make in 2 months what the total return in the S&P was for the past 2 years, or for just 2013, okay? And the break-even's right here. This is a chart of the S&P, and this is a green box, and as long as the market stays within this green box, you're going to make money. And you say, okay, you know, this basically, you're taking more risk relative to the reward received, and that's because this is what we call a very wide iron condor. This is a high odds iron condor, okay? And here's the cool thing about iron condors. It is, okay, Gautam's asking, isn't the risk only $330? You can't lose on both ends. All right, so this is true. You can't lose on both ends. I didn't show the calculations here, but basically the maximum risk on both sides is $1,000 because that's the spread difference minus the credit received. Okay, so the maximum risk is $730. You can run the calculations on your own to see what it looks like. All right, one of the beauties of iron condors is that it is a natural hedge against directional trading. Even if you don't want to completely scrap all of your directional trading strategies, you can add a couple iron condors to the mix and some other income trades if you want to help reduce the risk of getting chopped out. Because if you think about it and you're buying breakouts and you're getting stopped out, you know, those are trades that make money on a trend, right? And iron condors make money as long as there isn't a trend. It is a non-correlated strategy. You could also make the case for an inversely correlated strategy to directional trading, whether or not you're trading stocks, bonds, currencies, commodities. Think about this. If you're bullish on a stock, you really want it to move. Okay? If you're bearish on a stock, you really want it to move. Instead of the upside, you go to the downside. With iron condors, you don't want anything to move. So you can pair directional trading, which is technically a bullish volatility strategy, with iron condors, which are bearish volatility strategies. Now, there's a very fancy term for this. It's called dispersion trading. And this is a very small kind of example. You know, on an institutional side of things, dispersion trading is a completely different game. All right? So that should give you a pretty good primer of what iron condors look like and some of the advantages they have. We're going to move on now. If you've seen iron condors before, or maybe you've traded iron condors before, you're probably rolling your eyes right now. You say, yeah, easier said than done, because it's actually much, much harder to get that 37% than it looks like. And this is true. So we're going to take a step back, right? Because this is where most iron condor trading ends. You know, most trading information out there with iron condor says, okay, you know, you've got your odds, and they're very high odds, and you've got your reward, and you've got your risk, and if you just put, you know, one of these on a month, and you always make money, you know, you're going to make a lot of money. And to a point, to an extent, that's true. You will make money. Well, I'm not going to guarantee everything. There's SEC and FTC stuff, but iron condors are one of the simplest ways to build aggressive and sustainable wealth in the options market. It's also one of the easiest ones to screw up, okay, because it's I wouldn't say misleading, but there are hidden risks in this. So we're going to discuss 3 major issues with iron condor trading. Okay. The first one that we're going to talk about is the odds of success. So what we can do, and this is some fancy stuff, okay? If you've never seen this before, just take my word on it for right now, and we'll get to it later. But basically, there's something called odds of success, also related to the odds that the options will be out of the money, which means profitable, going into expiration. Some people call this probability of profit. One thing I want to warn you of, do not put on trades simply because you like the probability of profit. That is the worst thing to do, okay? A recent example a couple months ago, if you looked at oil stocks, and the implied volatility, the demand for options was very high because the oil stocks were sinking, you could probably sell some puts and say, oh, look at the amazing probability of profit. But that assumes the probability of profit is based off of what the options are currently pricing in. It does not take into account the actual risk in the market. And for oil stocks, for instance, they continued to go down. And there was, I wouldn't call it a crash, but a pretty significant and deep correction that the options market was underpricing. And so the probability of profit was quite misleading. Okay? All right. Here's the other misleading thing about the odds of success. Basically, there's some fancy calculations that we do in the options market, and we can figure out that the probability that all of these options will expire out of the money at expiration, or at least you'll be at break even at expiration, is 74%. And you say, okay, 74%, that's 3/4 odds. As long as I put this on every 4 times, and I lose money on one, I'll make money on the other 3. It's that easy, right? There's actually a hidden psychological trigger here. Because this is the odds of success with respect to these options being out of the money at expiration. But there's also another probability called the odds of touching. Okay? The odds of touching, so the odds that you will see significant tests of one side or the other is about 30%. It can technically be a little bit higher than that. Now you say, okay, that's fine and everything, but as long as my options expire out of the money, as long as I'm profitable at expiration, it doesn't matter, right? Well, one of the issues that you end up having is unrealized risk. So your position, let's just say the market rips higher from here, the odds of touching are 30%. What happens if you're in an iron condor and the stock rips higher, right? You can actually be in a lot of trouble from a psychological standpoint because you're going to have this massive drawdown and you're going to sit there and you're going to say, okay, do I really think that the market's going to revert right here? Or is it going to continue to trend higher? Am I going to get blown out of my position? I'm sitting at a loss of $2,000, but as long as the price stays at this current price, in the next 3 weeks I'll be back at break even. There's a lot of messy psychological stuff that goes on with this. Okay? Now, TC is saying in the Q&A box that there's very little reward compared to very high risk. There is always going to be a trade-off in the options market between risk, reward, and odds. Okay? If you want more rewards relative to the risks you take, you're going to have to change strategies, such as buying calls and puts straight up, trading directionally, trading with leverage. But in exchange for that, higher reward relative to your risk, you're also going to have lower odds. Okay, so this is a low reward, higher risk, high odds trade. Sam is saying in the Q&A box that iron condors do not work with volatility. That's not necessarily true. Okay, they can work as long as you're smart about it, and that's actually going to be discussed in a little bit. So the problem we have here is that facing an unrealized risk can actually be much larger than you think. And it's not fun. It's really, really not fun. There's a lot of messy psychological stuff that goes on here. There's a couple solutions to this. First off is have dry powder for adjustments and hedges and plan them beforehand. Okay, just assume that you're going to start off, you're going to have some point in time in which you will get squeezed in an iron condor, and as long as you have a little dry powder to the side to adjust the trade, you're going to do fine. Okay, there are some advanced adjustment techniques that you can consider, such as rolling or hedging or doing kite spreads that allow you to stay in a trade. One of the other things, and this is something that a lot of people don't get, is you probably need to bail earlier than you think. So if we go all the way back and we take a look at, we talked about our return on risk. It's actually a better deal to not hold on to iron condors all the way to options expiration. Don't try and maximize the credit you take in. In fact, this is an example of a 2-month iron condor. If you hold this for 1 month instead of 2 months, your odds will dramatically improve, and even though you don't catch the entire credit, you can catch 50% of the credit or more within a month. Here's one of the things that a lot of option traders don't get. Okay, this is a chart. This shows us, if you've been around the block with options trading, this is the theta curve. Okay, so everyone always says, oh, exponential theta decay. As long as you're short options between 30 days and 0 days, that's where most of the time decay is, and it's the most rapid. That's only for at-the-money options. So this is actually quite misleading. In fact, if you look at how the options market decays, okay, so this is a chart that shows us the total extrinsic value, okay, of an options market. So I think this was the S&P, and I did this study a couple years back, and it shows the extrinsic value 30 days later. Now, if you look at this, both on an absolute and percentage basis, the at-the-money options, so right around 1450, held their premiums very well between 2 months and 1 month to expiration. But if you look at the out-of-the-money options, they got punished. Right? They got hit really hard. Basically, out-of-the-money options decay a lot faster between 2 months and 1 month. And then there's not that much value to decay between 1 month and expiration. Okay, so it doesn't necessarily make sense if you're doing longer dated iron condors to hold all the way to expiration. You're not going to milk it as much as you think. John asking, how about commissions when you bail early? Iron condors can be a commission-intensive trade because you're doing 4 contracts total. One of the things that I suggest to people is to split up their directional trading and their income trading into 2 separate accounts so you can have 2 separate commission structures. It actually makes sense to do a spread plus ticket for iron condor trades versus just straight up a single contract. But yes, you will have to pay more commissions if you bail early. But, that's just the cost of playing the game. If you're sitting there and, you're at a decent profit and you say, well, I don't want to give up $4 per spread to bail on this iron condor. I want to hold on to it and just let it expire worthless. Well, you're going to be stuck in that trade for, however long it is to options expiration, and you might incur additional risks because stocks move, markets move. Okay, sometimes markets do trend. I'm going to start talking a little bit faster because I know I've only got 45 minutes total. Okay. TC's asking, what about iron condors on weekly options? It's really difficult to do iron condors on weekly options. First off, the commissions are an issue, right? Because weekly options will not give you as much of a credit, so commissions relative to the total credit received will be less than, it's just not as fun. Second off, everyone and their mother is already selling premium on weekly options. If you look at how the overall supply and demand dynamic is in the options market right now, everyone's chasing that theta dragon. And if way too many people are selling options on weeklies, then it's no longer a viable trade to look at iron condors. Now, I've started to do some research and I've started to do some back testing to see if that claim is true. I may be wrong on that, and there might be some kind of iron condor strategy, okay, that could potentially work, right? All right, the next major issue. You might say, okay, if I'm a net seller of volatility, if I'm selling options, I need to wait for a high VIX because that gives me high premium, and it also means I get better iron condor credit. So maybe I get better reward relative to my risk during a high implied volatility environment. On top of that, I can widen out my iron condor because there's a lot more premium during high volatility environments. Okay? So that may seem true, right? There's there's a lot of people that like to sell options when the implied volatility is very, very high. Sometimes the implied volatility is justified. For example, FDA events for individual stocks or earnings for individual stocks, and if you're selling options, you're going to get blown out because there's going to be that one trade where the actual risk is larger than what the options were pricing in. Oftentimes we see that in the VIX market. When the VIX is quite high, the actual volatility in the market is also quite high. When the VIX is quite low, the actual volatility in the market is quite low. Sometimes it makes sense to do iron condors in a lower implied volatility environment with a lower VIX because the market's not going anywhere. Okay, the market's dead in the water and it's range bound or it's just grinding higher. I don't like to use the VIX or implied volatility solely as a reason for getting into a trade. If we go back to our energy collapse example, a lot of people I know and I saw online were selling puts on things like Rig and Diamond Offshore and oil service names because the implied volatility was just so high and there was such fat premium, and then the stocks continued to collapse. And it didn't matter how high the implied volatility was because there was the actual volatility in the market was the bigger risk. The same kind of thing happens in iron condors. The biggest risk in this trade is not a rise or fall in the implied volatility. That's what we call vega, right? That's an options Greek, the change in option position as a function of implied volatility. The biggest risk in this trade is actual moves, okay, big moves. The actual volatility in the market or stock. If we see a big move, either to the upside or downside, that's where the real risk lies. Now here's the thing. When we see a very, very high VIX, what's going on? Okay, what's going on is that the market's selling off and people are scared and they're buying protection. They're saying, oh crap, I got to hedge because the market's about to fall apart. Now it rarely does because once all those people are hedged, there's no one left to sell, and so the selling stops, and then we see a snapback rally. Okay? When we see a big sell-off, that's when the VIX tends to be highest. If you put on an iron condor when the VIX is very, very high, and then we see a big snapback rally, there's still a lot of risk on that trade. You have to understand, with iron condors, risk is bidirectional. This is hard to understand for a lot of investors because they say, okay, I buy a stock and the stock goes up, that's good. If it goes down, it's not good. The majority of investors are long-only investors, so they're happy when the stock market rallies. But if the stock market rallies too hard, too far, too fast in an iron condor position, you're going to be in a lot of trouble. Okay? So the problem here is that iron condors in a high volatility environment tend to lead to large moves. Normally it's higher. Sometimes the market absolutely collapses, but iron condors tend to do okay during big moves to the downside because we do tend to see hard snapbacks. If you look at the largest moves in the market, like of all time, you do a sorting mechanism, they tend to come during bear markets or large sell-offs. The snapbacks are vicious. One very elegant solution here is to hedge with VXX puts. And what you can do is you can buy those puts, and if the market sees a sharp rally, the VIX will collapse, the VIX futures market will collapse, and VXX will go lower, and it tends to be a good upside hedge. And then you can take off the VXX puts and you can adjust. Okay? That may seem a little complicated, but the overall lesson is this. This is not a set and forget kind of strategy. Iron condors have to be managed actively. Okay, they do require less time, but there still is time and work involved. If you're willing to do that extra bit of work and willing to embrace a little bit more complexity, you're going to do better than 90% of all other people who have attempted iron condors. The other solution is to not go in full size and scale into different strikes as the market moves higher or lower. Okay. Bert's asking, what do you use as portfolio position trade risk for these 2 or 5%? I'm actually a little bit higher on the risk side of things. I dedicate 60% of my portfolio to directional trading and 40% of my portfolio to income trades. Now, iron condors are just a subset of income trades. There are other ones to consider. So Generally, it's about 20% on one month, 20% on another month, and then within that 20%, it gets split across different asset classes, and I've also got dry powder available. Okay, my goal is 20 and 20. If I can make 20% return on my risk on 20% of my portfolio, then I'm making about 4% a month. If I can make 4% a month, I'm set. Okay. Michael's asking for example trades. We'll get to that here in a little bit. Okay, this is more conceptual and it's light on example trades, but I've been around the block and I've done a lot of these. I just don't have them in this particular slideshow. Stan's asking if you can only lose on one side of the trade, why not just take the trade and then if it's a scratch, okay, move on. You know, that's one possibility. But if you continue to take, you know, there has to be some kind of risk involved here. Okay, if you're trying to just take it off for scratch every single time, you know, you will not get enough rewards to justify the risks that you're taking. Okay, last major issue. This is something that throws a lot of people off, but basically there's some fancy stuff going on in the options market related to what we call options skew. That means the implied volatility on out-of-the-money puts tends to be higher than the implied volatility on out-of-the-money calls. This means iron condors start off net short. If you do an equal weighted iron condor, which means the same amount of delta, basically I haven't discussed this much, but using delta to define your short option strikes, you know, will help you be consistent across assets and volatilities. It tends to start off net short. And what happens here is that when we're in a bull market and when we see non-reversion, so when we see uptrends, you're going to be in a lot of trouble with iron condors. Upside risk tends to be the biggest risk. Will this eventually change? Sure. If the market eventually changes trend, maybe it goes from an uptrend to a neutral trend, or maybe from a neutral trend to a downtrend, iron condors could be a little bit better or simpler to manage with less adjustments. But the upside risk is the biggest risk, and it's often the biggest risk that goes unnoticed. And what you'll find is that many option sellers out there are always short biased. You know, because they get into these trades and then, you know, you just get a tiny teensy little market rally and then they say, okay, the market's ready to fall apart. Not because of any kind of decent analysis, but because they're biased. They're always looking for reversion. You have to understand that there is a trend in the market, okay? And there are oftentimes the market will trend. 2 times out of the year, you're going to see a rip-roaring rally, and if you don't manage your iron condor risk, you're going to be in a lot of trouble. I know this because I've been on the wrong side of that trade before, okay? So the problem here, upside risk is the biggest risk. Iron condors in a grinding bull market are a huge pain to manage and take on a ton of risk. One of the things that I've been doing recently with my iron condors is that I go unbalanced on the call side. So specifically, I sell half as many call spreads as put spreads. This actually gets me really delta neutral. And then what happens is if the market does continue to grind higher, okay, I can adjust my trade and add a little bit more upside risk. Okay, and that's a very cool way to do it. The other thing to consider is wait for parabolic moves for better risk and reward. One of the sweet spots for income trading in the S&P and the Russell is to wait for a move above the second standard deviation Bollinger Band. That's when we get statistically overbought. And that is often the best time to enter an iron condor trade. Now, there are some traders out there that like to use very systematic entries and exits where exactly at 60 days to expiration I'm going to enter a trade. I don't like to do that. I like to add a little bit more discretion because I understand that the upside risk is the biggest risk. You know, if the market hasn't moved for 10 days and the Bollinger Bands are really compressed, volatility is probably going to expand. Why not wait a couple days and wait for that volatility expansion? You may get a slightly less credit, but you've also eliminated a significant amount of the actual risk in the market. Okay, so, you know, I've gone through a lot of stuff, and I've gone through a lot of risks. Again, iron condors are one of the simplest ways to make sustainable and aggressive wealth in the market. It's a wonderful hedge against directional trading. I did go through some of the hidden risks involved with iron condors, but they were really advanced risks. Okay, it's stuff you don't see as often as you would think. So don't be scared. Don't be terrified by the complexity of iron condors or everything like that. It's a lot simpler than I've put on today. I've just shown you some of the more advanced stuff. Okay. Now, I'm not going to try and sell anything on this webinar. It doesn't make sense for me. You've got, what, 3 or 4 more people to go through. I just want to open a conversation with you. Okay, so yes, I do have premium services and research products and everything like that, and I also trade with others in an awesome community of traders. But what I want to do today is I want to help you. Okay, this is free. I'm going to send you an Iron Condor toolkit. So Michael, who was complaining earlier about the lack of examples, there's going to be examples. Okay, there's going to be some videos and a trading journal for you to look at. Go to investingwithoptions.com/toolkit on your web browser. That will send you to a landing page that just enter your name and email. I'm not going to send you anything right now. On the thank you page, it will say, all right, cool, you registered, just go back to the webinar. Okay? So it's not going to force you into anything right now. Around Monday, I'll send out the toolkit to everyone, and you'll see basically how really awesome these kinds of trades are. Paste it in the box. Let's see if I don't even know how to do that. I think, all right, Reed's saying I got basically a minute left.
I'll copy and paste that link in there for you.
Cool, thanks. Any last minute questions? I can't believe I actually kept it under 45 minutes. So hopefully everyone will get a lunch break or a bathroom break before the next speaker. Michael's still complaining about no examples. You should demand a refund from this webinar. Seriously, get the toolkit. I'll send you a bunch of examples. If you want more examples, Michael, you can find me on my site at investingwithoptions.com, and you will get a flood of examples. There's just only 45 minutes. I can't talk about 10 different iron condor trades because that would take me an hour each. There's a lot of nuance involved. Sam's asking how to work out the standard deviation on a stock or the standard divination. I guess you could get a divining rod and wiggle it at your screen and figure out whether the market's going higher or lower. But the standard deviation on a stock, actually there's a really quick and easy way to figure this out with the VIX. Let's see if I can do it really quick. So you take the value of the VIX, which is 15. Okay, I think you can see this. You can see the 15. And you divide it by the square root of 252. Why 252? Because there's 252 trading days in a year. Okay, so that gives us about 9%. So when the VIX is 15, you should expect about 2/3 of the time for the market to move 1% up or down. Okay, so that's a standard deviation within a single day. If you want to figure out a standard deviation in a month, you just divide by the square root of 12. That gives you your standard deviation. It's a pretty cool way to just quick and dirty way to look at it. If you want to look at the standard deviation on different time frames, there's some fancy calculations you can do against the implied volatility. Okay, that wraps it up for me. It is a beautiful day outside. I'm going to go to the beach. I hope you all have a wonderful conference. If you have any other questions for me, you can go to investingwithoptions.com. There's a contact tab, and just hit me up. Pick up the toolkit too, and I look forward to hearing from you.